we're living in a strange moment. Everyone seems to agree that AI is, at least to some extent, a bubble. Yet no one can say when, or even if, it's going to burst. Valuations are sky high, revenue is lagging, and the financing behind the scenes is starting to look uncomfortably circular. So in this video, after already explaining why AI looks bubbly, we're asking a tougher question. What happens if the bubble actually pops? And why could the crash be worse than most people expect? Before we begin, a quick note. This is not investment advice. We're not predicting the future. We're simply laying out a few structural reasons why an AI-led downturn could be uniquely painful. As usual, we've got 3 reasons. Reason 1. A record share of household wealth is in stocks. Right now, roughly 30% of US household net wealth is tied up in the stock market, a historic high. That means an AI-driven market crash wouldn't just hit investors. It would hit ordinary households the way few crashes ever have. It might not necessarily be worse than 2008, which erased around 20% of US household wealth. But it could be, especially when you account for the enormous share of national wealth now wrapped up in crypto. If AI collapses, crypto likely collapses with it. Reason 2. The US has far less fiscal space. In 2007, just before the global financial crisis, US debt to GDP was roughly half of what it is today. The deficit was just 1.1% of GDP, and today, debt to GDP sits at around 120%, and the government is on track to run a deficit of around 6% of GDP in 2025. Translation: it will be significantly harder for the US government to borrow, spend, and stimulate its way out of a crisis. The same playbook used after 2008 and again during the pandemic. Reason 3. Shadow banking has exploded. Traditionally, governments draw a clear regulatory line between banks, heavily supervised, guaranteed, backstopped, and other financial institutions which aren't supposed to behave like banks. But banking is profitable, and everyone wants to act like a bank. That's how you get shadow banks, entities that take on bank-like risks without bank-level regulation. In booms, they're great. In crashes, they're catastrophic. Because when things go wrong, there's no formal backstop. People rush to withdraw their money. A shadow bank run begins, and the institution collapses. In 2008, shadow banks like Bear Stearns and dollar deposit issuing European banks became too big to fail, and the Fed had to step in anyway. But today, the shadow banking system is far bigger. In the US, private credit, a friendly rebranding of shadow banking, has ballooned into a hot $3 trillion industry, nearly 10 times its size in 2008. Add to that the booming stablecoin sector, whose issuers claim deposit-like convertibility into US dollars, while being regulated far more lightly than banks. Thanks for watching.